You've been told your whole life to save money, put it in the bank, be responsible, build a nest egg. But what if that advice, the advice your parents gave you, your teachers gave you, that society has been repeating for decades, is actually making you poorer? Not because saving is bad, but because where you're saving is quietly destroying your wealth every single year. Today, we're going to expose exactly what's happening to your money inside a standard savings account, with real numbers, real facts, and zero sugarcoating. Welcome to No BS Finance Daily. No jargon, no fluff, just what's actually going on with your money. Let's start with a number that should make you angry. The average traditional savings account in the United States pays 0.39% interest per year. That's the official FDIC figure as of late 2025. Now let's put that in real terms. If you have $10,000 sitting in a standard savings account, you earn approximately $39 in interest over an entire year. $39 on $10,000. Meanwhile, inflation is currently running at 2.7% per year. That means the purchasing power of your money is shrinking by 2.7% annually. So you're earning 0.39% while losing 2.7%. That's a net loss of over 2% every single year. Your bank account number might be going up by $39, but your actual wealth, what that money can buy, is going down by $270. You are getting poorer while feeling like you're being responsible. Let's zoom out and look at what this actually costs you over a lifetime. According to the U.S. Bureau of Labor Statistics, $10,000 in 2020 has the same buying power as $12,468 in 2025. In just 5 years, you needed 25% more money to buy the same things. Go back further. $10,000 in 2005 has the same buying power as $16,532 today. 20 years of inflation cut your money's value almost in half. And if you go all the way back to 1995, $10,000 then is equivalent to $21,183 today. Your money lost more than half its real value in 30 years, just sitting there. Now imagine you had $50,000 sitting in a standard savings account during that same period, earning under 1% per year. You would have watched your purchasing power quietly evaporate while your bank statement told you everything was fine. This is the savings account lie. The number goes up, the wealth goes down. Here's the part nobody explains. Banks don't make money by storing your cash. They make money by lending it out. When you deposit $10,000, the bank lends most of it out to other customers at 6%, 8%, even 20% interest on credit cards. They're using your money to make themselves rich, and they're paying you 0.39% for the privilege. It's one of the most lopsided deals in modern finance, and billions of people accept it without question because they were never taught anything different. Now here's where I want to be straight with you, because this channel is called No BS Finance Daily, and that means giving you the full picture, not just the scary half. There is a way to save in cash and beat inflation right now. It's called a high-yield savings account, and it's something most people have never heard of. Unlike traditional bank accounts paying 0.39%, high-yield savings accounts, mostly offered by online banks, are currently paying between 4% and 4.5% annually. With inflation at 2.7%, that means you're actually ahead. The reason online banks can offer this is simple. They have no physical branches, no tellers, no overheads. They pass those savings on to you as higher interest rates. So if you're going to keep cash in a bank, a high-yield savings account is the only intelligent place to put it. Here's the uncomfortable truth, though. Even a high-yield savings account at 4% is not going to build your wealth. It'll protect your purchasing power. It'll beat inflation, but it won't grow your money in any meaningful way. To actually build wealth, to get ahead rather than just stay even, you need your money working harder than any bank account can offer. Here's a number that puts it in perspective. The S&P 500, a simple index of the 500 largest American companies, has returned an average of 10% per year since its creation. Not every year. Some years it's up 30%, some years it drops, but averaged out over decades, 10% per year. Compare that to your savings account. $10,000 in a savings account at 0.39% for 30 years becomes approximately $11,200. $10,000 invested in an S&P 500 index fund at 10% per year for 30 years becomes approximately $174,000. Same starting point, same 30 years. One gives you $1,200 extra. The other gives you $164,000 extra. That is the cost of keeping your money in the wrong place. So here's the No BS Finance Daily breakdown of where your money should actually go. First, keep 3 to 6 months of living expenses in a high-yield savings account as your emergency fund. This money needs to be accessible, so a bank account makes sense. Just make sure it's a high-yield one, not a standard one. Second, anything beyond your emergency fund should be put to work. That means investing in index funds, ETFs, real estate, or other assets that historically outpace inflation by a significant margin. Third, stop letting your bank tell you that 0.39% is acceptable. It isn't. You have options, and now you know what they are. The system isn't designed to make you wealthy. It's designed to make banks wealthy, using your money. The good news? Once you see it, you can stop playing by rules that were written against you. On this channel, we're going to keep breaking down exactly how the financial system works and what you can actually do about it. If this opened your eyes, hit subscribe. Share this with someone who still thinks their savings account is working for them. I'll see you in the next one.